May 6, 2010, 2:32 in the afternoon, New York. The Dow Jones Industrial Average drops 600 points in 5 minutes. Not over a week, not across a quarter, 5 minutes. Procter & Gamble, one of the most stable stocks in American history, loses 37% of its value under 4 minutes, then recovers as if nothing happened. Traders on the floor stop talking. They just watch, because nothing in their models, their experience, or their intuition explains what they are seeing. $1 trillion in market value disappears and then comes back. For 5 years, nobody knows why. When they finally find the answer, it is a man in a suburban house outside London, wearing a tracksuit, trading through a company registered to his parents. His name is Navinder Singh Sarao, and he never once left his living room. To understand what Sarao did, you first need to understand what he was not. He was not a hedge fund manager. He had no Bloomberg terminal suite, no risk committee, no compliance team breathing down his neck. He did not work inside a glass tower in Canary Wharf or on the 47th floor of a Goldman building. He was a trader, a retail futures trader, operating from a semi-detached house in Hounslow, West London, a neighborhood better known for its proximity to Heathrow than to global finance. He traded E-mini S&P 500 futures, contracts that track the performance of America's 500 largest companies. These are not exotic instruments. They are the most liquid futures product in the world. Every day, billions of dollars move through this market. And Sarao moved through it like someone who could see 3 moves ahead in a game where everyone else was still reading the board. He had been doing this since the early 2000s. His returns were extraordinary, not by the standards of retail traders, but by any standard. Year after year, he outperformed. His strategies were so effective that at one point his brokers flagged him internally, not because he was doing anything wrong, but because they assumed something had to be wrong. People who beat the market consistently either have an edge, or they have information nobody else has, or they are doing something nobody else has thought to do. Sarao was doing something nobody else had thought to do, or at least nobody else had thought to do it at that scale. What was at stake here was not just his money. It was the integrity of a pricing system that underpins pension funds, institutional portfolios, insurance reserves, the entire architecture of Western retirement wealth. He was not stealing from individuals. He was distorting the lens through which the entire market reads itself. And for years, the market could not tell the difference.
Every market has a book. The order book is a live record of every offer to buy and every offer to sell at any given price. When you look at the E-mini S&P 500 futures market, the book shows you thousands of orders stacked at different price levels. Buyers on one side, sellers on the other. The gap between them, the spread, is where the price lives. Most participants look at the book the way a driver looks at a road. It tells them where to go. If there are heavy buy orders at a certain price, the market tends to move toward them. If sell orders pile up above, the price resists going higher. Sarao looked at the book differently. He saw something that the infrastructure of modern trading had not caught up to yet. He saw that the book could lie, not in a crude or obvious way, but in a technically precise way that the systems of the time had no mechanism to detect or penalize. The mechanism was simple. Place a massive sell order far enough from the current price that it never gets executed, but close enough to the action that it distorts how other traders read the market. Here is what that does in practice. If you see a wall of sell orders just above the current price, your algorithms, your intuition, your risk models all tell you this market has resistance here. It is not going up. Sellers are ready. Don't buy aggressively. So prices drift lower. And if you have a short position, a bet that prices will fall, you profit. And then, before those orders get close enough to execute, you cancel them, you modify, you pull the offer. The wall disappears. You take your profit on the downward move and you reverse, and the cycle begins again. This practice is called spoofing. It existed before Sarao. Traders had done versions of it by hand for decades, placing and pulling orders to create false impressions. But Sarao did not do it by hand. He built, or had built for him, a custom algorithm, a piece of software that automated the entire process, placing, modifying, and canceling large layered sell orders at precisely calibrated distances from the market price. The orders moved dynamically, always staying just out of reach of execution, always large enough to register as significant market pressure. He called his key tool the dynamic layering function. What it created was a persistent, automated illusion of supply that the market was designed to trust. Think of it like a projected image on a theater backdrop. From the audience, it looks like a real landscape. The actors move through it as if it were real, but step close enough and there is nothing there. Sarao's orders were the backdrop, the audience was the market, and the audience kept acting as if the landscape were real. The sophistication of this approach is easy to understate. First, the scale. Sarao was not placing small orders at the margin. He was placing orders worth hundreds of millions of dollars, sometimes approaching the limit of what regulators later described as dominant. In a market that moves trillions of dollars a day, that's a meaningful fraction. Second, the timing. The algorithm was not static. It adjusted continuously, watching the market price, maintaining the orders at a distance that kept them perpetually threatening but never executed. This required real-time calculation that human hands could not replicate. Third, the plausible deniability. At the time, order cancellations were not unusual. High-frequency trading firms cancel 90 to 99% of their orders as a matter of routine. It's part of how they probe the market and manage risk. Sarao's behavior, while extreme, was partially camouflaged by the broader culture of cancel and replace that HFT had normalized. Fourth, and this is the point that defines the plan as genuinely sophisticated, he understood that market structure itself had changed in ways that regulators had not caught up to. The shift from traditional floor trading to electronic order matching had happened fast. The rules, the monitoring systems, the legal frameworks, they were designed for a different era. Sarao was operating in the gap between the new market and the old oversight. He was not the only one who had noticed this gap, but he was among the most systematic in exploiting it. Between 2009 and 2014, Sarao extracted an estimated $40 million from the market using variations of this strategy. That number sounds modest against the trillions in daily volume, but consider what it represents: consistent, systematic extraction from a market that is supposed to aggregate information from millions of participants and arrive at fair prices. He was not just profiting, he was polluting the signal. Every time his phantom sell wall pushed prices down, other traders made decisions based on a market signal that was deliberately fabricated. Algorithms bought or sold based on his fiction.
Risk managers set positions based on it. The book, the mechanism that is supposed to represent true supply and demand, was being authored in part by a man in Hounslow who had no intention of actually selling anything. The plan worked precisely because the market was too complex for any single participant to see its own distortion. That complexity was not a bug in Sarao's strategy, it was the strategy. May 6, 2010 was already a nervous day. Greece was in crisis. European markets were volatile. American investors were watching the news cycle and the bond spreads simultaneously. Uncertainty was elevated. The market was primed. Sarao was active that morning, more active than usual. His algorithm was running, placing and pulling large sell orders in the E-mini futures market, creating the artificial pressure he had been creating for months. But this day was different. Not because Sarao changed his approach. His algorithm ran essentially as it always had. The difference was what the market brought to the encounter. Markets have feedback loops. When prices start to fall, algorithms that are programmed to stop losses automatically begin selling. Other algorithms interpret that selling as a signal and sell more. Liquidity providers, the firms that stand ready to buy and sell to keep the market functioning, start pulling back because their own risk limits are being triggered. In a stable market, these feedback loops are managed. Liquidity absorbs shocks. The book is deep enough that sudden selling gets soaked up. But on May 6th, liquidity was already thin. The macro environment had moved cautious participants to the sidelines, and into this thinner-than-usual market, Sarao's algorithm was pushing its usual false signal of supply. At 2:32 p.m., the cascade began. What happened next is still contested in its precise mechanics. The full official account took months to construct and remains debated by academics. But the outline is clear. A mutual fund, later identified as Waddell and Reed, began executing a large automated selling program in the E-mini futures market. Their order was designed to track volume, executing slowly to minimize impact, but the market was already under pressure. As their selling met Sarao's phantom walls, the book, already thinner than normal, began to buckle. High-frequency trading firms, which normally provide liquidity, detected the instability and stopped quoting. In some cases, they switched to buying only, then stopped trading entirely. The E-mini dropped sharply, and the E-mini futures price feeds directly into the algorithm of every system that prices stocks against it. Individual stocks began to execute at absurd prices. Accenture, a company worth billions, briefly traded at 1 cent. Apple briefly traded above $100,000 per share. These were errors, trades that occurred in the milliseconds when market-making algorithms had stepped away and residual orders matched with nothing. The Dow fell 998 points intraday. $1 trillion in equity value vanished in minutes, and then, almost as suddenly, it recovered. Because the cascade was triggered by temporary illiquidity, not fundamental collapse, when the selling exhausted itself and the phantom orders disappeared, the book restabilized. Prices snapped back. For the investors who had stop-loss orders that triggered at the bottom, the snapback offered no relief. Their positions had been liquidated at the worst possible moment into a market that no longer existed by the time the trade settled.
Sarao did not intend to cause the flash crash. This is important. His algorithm did not have a mode for destabilized global equity markets. He was running the same strategy he had run for months. The difference was that the conditions around him amplified an effect that had previously been contained. He was exploiting a fault line that he had not created. He just happened to be standing on it when it moved. For 5 years after May 6, 2010, regulators and academics built competing theories of what had caused the crash. High-frequency trading was blamed. The Waddell and Reed cell algorithm was scrutinized. Market structure fragmentation was studied. Nobody looked closely enough to the order book to see the phantom walls. Or rather, they looked and could not distinguish Sarao's spoofing from normal HFT cancel and replace activity. He was camouflaged inside the very market practice his strategy had exploited. It was a researcher at the CFTC, years later with improved analytical tools, who finally built the picture. By reconstructing the order book second by second, she could see what the automated surveillance of 2010 had missed: a pattern of massive, layered orders that appeared and disappeared with mechanical regularity, always just ahead of price moves, always in the direction of Sarao's positions. In 2015, Sarao was arrested at his home in Hounslow. He answered the door himself. The authorities who came for him found a man who had not moved his profits offshore, had not built a legal fortress around his trading structure, had not prepared a sophisticated exit strategy. He had, to a significant extent, given much of the money away to trading schemes he himself had been defrauded by. The man who had seen a systemic vulnerability nobody else could see had not seen himself becoming a target. There is a specific cognitive trap that runs through this entire story. It is not unique to finance. It shows up in medicine, in engineering, in law, in any domain where the tools are sophisticated enough that most participants cannot fully audit the system they are operating inside. The trap is this: when a system is complex enough, humans begin to trust it as if it were neutral. The order book is supposed to reflect reality, the actual intentions of actual buyers and sellers. When it became electronic and high speed, it did not become more neutral. It became more manipulatable. But the complexity of the technology lent it an aura of objectivity that manual floor trading never had. A floor trader can be read. You can watch his face, his hands, his body language. You can develop intuition about whether his offer is real. The electronic book has no face. It presents numbers, and numbers feel like facts. Sarao understood, whether consciously or through intuition developed over years of observation, that the market's trust in its own data was its most exploitable feature. He was not hacking the system in a technical sense. He was exploiting the sociology of how people relate to technical systems they cannot fully understand. The insight here is not simply markets can be manipulated. That is too broad to be useful. Markets have always been manipulatable. The precise insight is this: the more sophisticated a system becomes, the more participants place faith in its outputs, and the less they interrogate the inputs that produce those outputs. This is not irrationality, it is adaptive. Nobody can fully audit every system they depend on. We trust the electrical grid without understanding fault tolerance. We trust pharmaceuticals without reading the clinical trial data. We trust aircraft without understanding aerodynamics. But that necessary trust has an exploitable edge. When the inputs to a trusted system can be manipulated by a single actor, the outputs become fiction, and everyone downstream makes real decisions based on that fiction. Sarao found the input that nobody was watching. He modified it, and the entire market updated its beliefs accordingly. The flash crash was not a malfunction. It was the market faithfully processing information that was partially fabricated. It worked exactly as designed. The design had a gap, and the gap was large enough to swallow $1 trillion for 6 minutes. There is a version of this story that is about one unusual man with a specific edge in a specific market. But the version that holds up under pressure is about something else. The way all of us relate to systems we benefit from but do not understand. We accept the outputs of complex systems as ground truth because the alternative, questioning every data point, auditing every process, is cognitively impossible. We are all running heuristics that say if the system produced this number, the number is probably real. Sarao lived at the intersection of that heuristic and a system that could be fed false inputs. He was not a genius in the sense of having solved an impossible problem. He was someone who saw that the problem was not being looked at all. And in any complex system, financial, medical, political, or technological, the unsupervised input is always the same risk. We keep building systems we trust. We keep forgetting to ask who writes the data the system trusts.
Sarao was ultimately sentenced to time served, 1 year of house arrest, and cooperated with regulators in their broader investigation into spoofing across global markets. Courts and academics still debate his precise contribution to the flash crash. The CFTC's own economists later published research questioning whether spoofing alone could have triggered an event of that scale. But that debate is, in some ways, beside the point. What remains is the structural reality Sarao exposed. A market worth trillions of dollars was, at its most fundamental level, trusting a data feed that a single person in a tracksuit could quietly author. The reforms that followed, new surveillance tools, spoofing prohibitions with real enforcement, circuit breakers, addressed the specific mechanism. They closed the gap Sarao had used. But every complex system has gaps. The reform always arrives after the failure. The gap is always closed in response to someone who found it first. Which leaves the question worth sitting with. In every system you currently trust, financial, algorithmic, institutional, who is already sitting in the gap you have not found yet? And how would you know?